Folks, today I'm going to teach you how to trade a overcapitalized market versus an equal balanced market when markets get out of balance. Now, you may call this arbitrage. This may be a little bit advanced for some, but I'm going to try to make it as simple as possible for you and explain to you what the issue is. But I need you to understand the difference between an equally weighted market and a capitalized market, because if you don't get it, it's going to be hard to understand this. So right now, we're looking at the NASDAQ 100, number of stocks in the NASDAQ 100. NASDAQ 100 is the top 100 stocks in the NASDAQ. The FANG stocks, the Google, the Microsoft, the real big stocks. That's why it's the NASDAQ 100. So right now, 71% of stocks, remember this number, 71% of stocks is trading above the 50-day moving average. So if you were looking at the NASDAQ 100, which we'll look at right now, it would actually look pretty bullish. Let me just show you a chart so you could see exactly what I'm talking about right now. This is actually pretty remarkable, and the divergence is hardly ever this big. So if you're looking at the market, we made all-time highs yesterday. The market's just down one day. This looks like one hell of a bullish market, right? 71% of stocks trading above the 50-day moving average. That's a very, very bullish market. Again, 71.56%. But now let's look at the NASDAQ, the entire NASDAQ exchange. Not just the top 100 stocks. Let's look at all of the stocks on the NASDAQ and see how many are trading above the 50-day moving average. Look at this, 37%. I would say that's what? That's about half, 31, 30, 72, about 100% difference, 100% difference, all right? There is over 70. This morning it was like 75% of stocks versus 37% of stocks. There's roughly twice as many stocks in the NASDAQ 100 trading above the 50-day moving average as is in the NASDAQ composite, which tells me that there's a large concentration right now in stocks that are up on the upside overbought, and large cap stocks. Amazon, Apple, Facebook, Nvidia, Google, all of these stocks have been really, really going up. But most stocks, let me show you this is MDY, this is the Midcap 400. This is not the S&P 500, but midcap stocks. So stocks that are not as high, doesn't have that large capitalization. Again, it's like comparing the NASDAQ to the NASDAQ 100. Notice where we're at right now. We're not even bullish. Most of the stocks in the midcap are trading below the 50-day moving average. This is really a better representation of the market. And here's what I believe. I believe that those large NASDAQ 100 stocks are going to start deflating, and the smaller stocks, the mid-cap stocks, are going to remain strong, or the larger stocks are going to deflate faster than the smaller stocks. In other words, there is a gross, when I say gross, this is about as gross as you can get, 71% versus 37% in the same index, NASDAQ 100 versus the NASDAQ. Sometimes you'll see 71%, 60%, 55%, 45%. But over 70 and less than 40? That's nuts, okay? So the way we take advantage of this is we want to sell large capitalized stocks and buy equal capitalized stocks. And there's a way to do it. So this is the RSP. This is the S&P 500. If you were to take all the capitalization and strip it away, basically every stock in the S&P 500 gets equal voting power, all right? Equal share. So Amazon isn't like 1,000 times bigger than Bank of America, for example. It's not 1,000 times bigger, but it may be about 50 times bigger. So the point of the matter is, and I'm not kidding, I mean that. The point of the matter is, this is really what the S&P equal weighted looks like. Let's look at the S&P on a non-equal weighted and see what it looks like. I'll bet you it's trading higher above the 50-day moving average. So let's look at that right now. See, look at the S&P 500. See how bullish it is? Look how far it is away from the blue line, which is the 50-day moving average. And then look at the even weighted one. So I believe the S&P 500 that's not equal weighted, SPY, is going to come down, while the RSP is going to come down less. So what I propose is selling for every share you sell in the SPY, you buy a share in the RSP, right? You sell the SPY and you buy the RSP, because I believe that spread is going to tighten, because stocks that are equal weighted are going to drop a lot less than stocks that are large capital weighted. And you don't have to do the RSP. You could do the mid cap versus the SPY. You could buy the mid cap and you could sell the SPY, because look at the mid cap. It looks a lot more. This is the mid cap and this is the RSP, the equal weighted S&P. But again, I think the best bet for the buck is to sell the SPY, right? And buy the RSP. If the market really goes crazy, you have a perfect hedge. You have an S&P hedge. So this is only taking advantage of the fact that the Amazons, the Apple, all those stocks are going to cool off, while the other stocks, the smaller stocks, are going to stay put. And I believe that's going to happen. So you can either sell the SPY and buy the RSP, or sell the SPY and buy the mid cap. And either way, you're going to get that type of a hedge. Hope that helps. And it's a little bit advanced, but this is a good exposure to basic arbitrage. Take it easy, and I hope that helps.